Good morning, ladies and gentlemen. This is Brad Matheny. Today is the 25th of June. I am creating this video to try to help you understand what I believe is coming next in the markets. Try to resize this a little. Which is, well, that didn't work. Hold on. Which is to tell you that we are entering into a new phase. Okay, we have had a lot of news this weekend. Russia, the Russia coup, a lot of political news. Don't know what to make of that. It is going to continue. It is going to get wild. But most importantly, from a fundamental standpoint, we have now exited the 15 plus month lag period of the Fed starting to raise interest rates in early 2022. We have gotten beyond that. We are now in a contractionary phase of the markets. It's very important to understand that we have moved beyond the speculative bubble bump. Okay, we had, and let me try to explain this to you here. This is my SPY chart. Here's COVID. Let me draw some vertical lines. Here's COVID. Here is the beginning of 2022 when the Fed started raising interest rates. We'll change that to a blue color. We have a 15-month cycle which takes place. I'll draw that right across this RSI. So from January, roughly, all the way into January here, that's 12, February is 13, March is 14, April is 15, we'll go to the end of April, roughly May right there, and now we are entering into the new phase, which, if I can drag this, is coming right there. And the new phase, ladies and gentlemen, is a contractionary phase, a deflationary phase, where the action of the Fed raising the interest rates has propagated throughout the markets. We have kind of had our lag time, our 15, 16-month lag time. Now we're starting to move into the reality of higher interest rates, higher credit rates, worldwide adjustment to these values, these credit market, debt market valuations, and I believe we're going to move into an extended tightening phase. Now, in the past, I've shown you this chart, and of course I have to change it here, which is my SPY. This is the NASDAQ on the top, the SPY on the bottom, and then my custom Fed funds rate value down here near the absolute bottom. You can see the Fed funds rate has moved up into an extreme kind of an aggressive mode, upward trending. That means that the rates of the Fed are starting to really bite harder than they were at any time, all the way going back until we go all the way back. We do not have any, here we go, all the way back to 2008, 2009. So we are at a very strong deflationary underlying market condition. We are at a point in time where the Fed funds rate should be driving investment into safe havens, driving investment into dividend producing stocks, driving investment away from speculation, away from gambling, away from Bitcoin potentially and cryptos. Not saying that's going to come overnight, but I'm telling you that the underlying pressure in the markets right now is very strongly to the downside in a deflationary type of a unwinding cycle, which is why I believe we are going to be moving into this extended flagging formation as I've drawn here. I'll leave it right there. So I believe we've reached our peak. This is the peak that I was telling you about. Remember, I have been pretty well dead on about all of these turns. I believe this is the peak in the market. This is the last hurrah of our 15-month time frame. Again, let me try to draw the 15-month time frame here and show you why it's so important. So the Fed started raising interest rates right back over here in early 2022. Now we go out to 2023, January, February, March. We'll go to the end of April. Pretty much right there. So beyond this, we start moving into a brand new phase. Okay, won't let me copy it. So beyond this, we start moving. There we go. Clone. Into a brand new phase. And the phase we start moving into is deeply contractionary. Okay, so understand that this little blip here was a last hurrah, was a short squeeze. You can see it. I mean, look here, folks. I'm gonna try to highlight it. Look here on this where the actual phase ends. Let's go right to here. Oh. Let's go right to here. Change it to a dark green, and there you go. So that's the end of the lag period. That's the end of Q1 2023, which is carrying over. Remember, it's still in the lag period here. This is still, the party is rolling. Okay, this is essentially what's happening as the Fed starts raising rates. Doesn't really take effect. We have about a 15, 16, 17 month lag time. Then we start to get into reality. When we start getting into reality of higher rates, rolling over debt, consumer spending, housing market declines, lack of speculation, liquidity tightening, now we have a whole other world. Okay, and we had a little bit of a blip right here between this area and this area where we had a short squeeze. A massive short squeeze took place, causing the market to move up, crushed the shorts. The shorts were really correct. I hate to say it. They were the ones that understood that this was the end of the lag period. They just loaded up too soon. They didn't understand that we had this end of cycle hurrah. Now, the next cycle moves are going to be within this consolidation range. So again, when you look at this and you look at this cycle phase, let me carry it all the way out to the election, which will be right here. We are looking at basically staying within basically this range on the SPY and roughly this range on the NASDAQ all the way out until the election. We are going to be in a consolidated phase, which is going to be very dangerous. It's going to see some pretty good rotation, 10, 11, 12, 13% rotations. But I need you to be aware that we are going to be moving into a fairly dangerous 15, 18 month contractionary phase. And the warning I have for you is that speculative stocks are still, capital is still going to move around. It's going to be looking for opportunity, but it's going to be moving, you know, probably 70, 80% more aggressively into stronger earnings, dividend producing companies. That means that technology, FANGs, you're going to see some strength still in those. Healthcare, biotech, you're going to see some strength in there. Infrastructure, defense, you're going to see some strength in there. Commodities, probably some strength, particularly in gold and metals and miners. Maybe even water and others. But understand that it's a totally different market. This is the rally phase, zero interest, no problem, party's rolling on. Oops, the Fed raised interest rates, now we're going to have a correction. Okay, correction, then we base. Oh, we still have opportunity, lots of capital left. Let's start playing around with some of these bounces. Okay, we bounced up, we had a solid 25%, 38% reversion. Now we get into the short squeeze, there's our last hurrah. Now we're coming back down. This is going to be a broad unwinding period. It's going to take 15 to 16 months to complete, and you need to be aware of how capital is going to shift. If you have not protected your capital yet, do it right now. If you have not moved away from excessive risk, if you're still letting everything ride without touching anything in your investment or 401k or retirement account, you need to make some changes. You need to start thinking about the fact that you could watch 20 to 30% of that capital go away over the next 15, 16 months. There is a real risk ahead of you. And there is a real risk that you're going to have your capital locked into something that's not going to be performing very well. The timing of the next move is very critical. And this is why you want to follow my research. You want to visit me at MENT.com. You want to pay attention to what I'm telling you. And you want to prepare for this next move. If you're into Bitcoin, if you're into crypto, if you're into AMC or these other meme stocks, I'm going to warn you right now that you might see some bumps. You might see some interesting little moves like we just saw in Bitcoin last week. But underlying the trend, you have a broad deflationary devaluation cycle phase setting up that's going to maybe last for the next 2 years, maybe longer. And that's what I'm trying to warn you about right now. As an investor, you need to change your thinking right now. It's not going to stay the same. You're not going to find the opportunities. In fact, I created this to try to highlight. Now, I might not be able to get all of it in here. Let me shrink this down. Try to drag this over. Okay, this is what I call the MENT movers list. And this is the TT ETF list. So I've highlighted these in blue. And what I'm looking for, I'm going to start on this side, which is the weekly, okay? What I'm trying to do is show you here on weekly data what I'm really looking for. Okay, so the QQQ, XLC, IXN, XT, QTech, and IYC are all bullish. They're all currently flat. We're in bullish trending. We have moderately strong thrusting pattern. Thrusting is a short-term trend indicator. And the reason I'm calling it strong, even though they're red, is they're positive numbers. They're not negative numbers like this. So when you're in an area like this and you get this positive bull-bear shift, what's happening is we're in a bullish trend, we're flat, we're in a bull-bear ranking that's moderately positive, but we're seeing it start to shift on a week-over-week basis up to the positive. These are areas that you want to pay attention to because these are areas where we may find some opportunity over the next couple of weeks and months. Okay, now notice IGV, IGM. They're bull-bear rank of 4. They moved up 1. They're flat. They're bullish. And then we have positive numbers over here in thrusting. Notice IYH. It's a 4. Moved up 2 last week. It is bearish, flat. It is positive ranking. The reason I'm highlighting these is, again, they're gaining strength in a basing, bottoming, flat type market formation. Here we have IJX is a 2. It moved up 5 last week. That's a big move. Okay, that means it's gaining quite a bit of strength. It is still negative. I highlighted it because I believe this 5 move is going to prompt a thrusting pattern to the upside. We're in distribution, and we have XLV, which is, again, 2 and a move of 5, flat in a bearish trend, positive thrust with 20.93. Come down here, we have one last, which is IGF, negative 3, moved up 3, flat, bearish trending, and we have a negative 50 on the thrusting pattern. Again, this move of 3 to the upside, that means that it's gaining strength. It's actually trying to base and bottom. Now notice that GDX is, let me find GDX right here, is 4, negative 1. GDXJ is negative 5, negative 3. Really not finding any strength on the weekly basis. But when we come over here to the daily side, which is this side, what we're looking now is look at some of the symbols we have here. Okay, we have XLV, 5 and 1, flat bullish, positive thrusting, IHI, IYH, IXJ, warning, flat, 4-1. All of these have moved up. SDS moved up here. This is a short trigger. It's 0, moved up 6. So it's really kind of weakening. I didn't highlight this one. And this is something you got to be aware of. Inverted symbols move in the opposite direction. We have GDXJ -5 moving up 1. GDX and GDXJ -5 moving up 1. Both in bearish trending, both negative thrusting, but in green thrusting color. I want you to be aware this is probably a pretty good early move. Now these that are moved down, QTech, XT, IYF, SOX, these are long. They're moving downward. We've been in the trade for many days. These are the number of days we've been in the trade. We've already hit our targets. These are weakening. These will eventually get stopped out if they continue to weaken. Same thing here. XLY, IYC, XLC, Jets. These are long trades. They're moving down. We are bullish. We've been in these trades for 2, 3, 4 weeks. We've already hit targets except for this one in Jets, and they are going to begin to weaken and move downward. So what you're really looking for right now, ladies and gentlemen, is you're trying to move into sectors that are going to be decent performers for Q2 and Q3. So we're moving into Q2, which is going to, Q2 earnings is almost here. In another 20, 30, 40 days, we're going to get a slew of earnings. I want you to be aware that these earnings are going to reflect past performance and forward guidance. Forward guidance is the most important thing. Forward guidance is going to tell us what we really need to be concerned about. Is forward guidance growing or contracting? If it's contracting, then we are in that deflationary devaluation cycle phase, and you need to be very, very cautious. Okay, very, very cautious. I believe that's what we're looking forward to over the next 15 to 25 plus months, is contractionary forward guidance. At a illiquid market, we're going to see a contraction in assets, and capital is going to be moving into safety, which is sectors that are either undervalued or ignored and have a chance of returns, or sectors that are going to continue to perform with a moderate degree of risk and moderate degree of ROI. So again, be aware that anything that's got 4, 5, 6, 7% ROI on an annual basis potentially is going to look really good for the next couple of years. Okay, compared to things that are minus 10, 15, 20%. Okay, now I wanted to highlight this. And this is my US to Global Custom Index. We've got this blow-off topping pattern here. And I wanted you to be very aware that I think the global markets are going to contract much sharper than the US markets. And again, that's going to create a safe haven where we may see a bit of a blow-off kind of a peaking formation here. So if the foreign markets start to contract sharply, we may see the U.S. markets hold up a bit as foreign capital rushes into U.S.-based assets, kind of like we saw back over here. We had a blow-off top, foreign markets started to contract, U.S. markets contracted a bit, then consolidated. So this is kind of what I'm really thinking is going to happen. We're going to end up in this sideways range for maybe 2 years, where global markets contract, U.S. markets will contract as well, but they're going to hold up better. Foreign markets here went from 50% down to 10%. That's a 40% decline. U.S. markets went from 26% down to 0, so they saw a 26% decline in the worst case scenario at the end of 2018. So understand that this is going to be the difference of protecting capital. Are you willing to risk 40% or are you willing to risk 10%? What do you think is going to be the most logical answer? The most logical answer is going to be move capital away from global capital risk. Find assets that are capable of performing and strategies that are capable of performing throughout the next 2 years plus. Next, I want to highlight the range as I showed you here, the NASDAQ to the SPY to the tightening Fed. This is very aggressive, very difficult to deal with. We are likely going to see it move back down into these consolidation channels over here. This is the SPY here. This is the NASDAQ here. Be very aware you're looking at a 13 or 14% contraction in the SPY and the NASDAQ, maybe a bit more, and it's not going to go away. It's going to be like this for the next 24 plus months probably. Lastly, I want to show you this, which is my market cycle ratio. This is something I don't show very often. You can see if we look back here, 2009 contraction, then we had the expansion phase. Then we had the 2015-16 contraction, then we had the expansion phase. Notice that 2017 and 18 really didn't show up here much. Neither did COVID. This is COVID right here. Didn't really create much of an issue on this chart. What's happening, excuse me, is that we're measuring economic function. We're measuring cycle economic function. And what we've done is we've seen this broad function decline here. So understand that the way I look at this, I kind of draw a middle area here across this area. Then I draw a middle area here. It's kind of highlighted with this blue box here. Then I'll draw another middle area across this area, which is this 0.50 area. Then I'll draw another middle area across this area up here. So we've got 4 levels. 1, 2, 3, 4. Okay? Now, where we're at now is we've gone from 4 down to 3. Okay, we've seen a contractionary phase in the markets. If we're able to hold up here and there's no crisis, there's no major financial event, no more contractionary mode, then we will stay above this green line right here and we will try to hold this level, move through the 2024 elections and maybe start to rally back out of it. But, big warning here folks, but if we see a continued contraction event in beyond what we are expecting right now, then we will shift down into this area. And this would reflect another 20, 25, 30% decline in the markets, potentially putting us back down near COVID lows. And again, that is something that is a very real possibility. Okay? Right now we're holding up. Right now we're basing. We'll see how it plays out. We could slide down into this area just with asset prices, home prices coming down, destruction of the credit market, which the Fed is going to do anyway with the higher interest rates. Understand that we're in a very difficult time. You want to really start thinking about how you're going to trade, what you're going to trade, and who's going to provide the best information for you, which is part of the reason why I'm providing this this video. So now I'd like to urge you to come to my website. This is my website, MENT.com. I do the research, you make all the decisions. My job is to provide you the best detailed research that I can and to keep you prepared. Right now, currently, in fact, let me show you. We are currently set up in a mode that has been very well protected for MENT.com members. One second. We are 20% stocks, 40% cash, 25% metals, 15% bonds. I'm tracking the equities and the sectors for you here. We've been like this for about 3 weeks. Understand that I've been warning my members and my followers to protect capital. I've been telling everyone, do not chase this rally. Do not believe that this rally is a new bull market. This is a short squeeze. You need to be very aware of the risks involved. You need to protect your capital. You need to pull your profits. You need to set trailing stops. And you need to prepare for what is next. Now, in the alternate investment, if you can't hold metals, we're 20% stocks, 60% cash, and 20% bonds. Be very cautious. I'm warning you right now. The world is about to do something very funky. We're going into one of the biggest credit contraction phases and devaluation phases we've seen in more than 15 years, literally. So I urge you, come to my website, learn what I do, follow my live webinars, start the Expert Growth 60-day trial for $34.99. Let me help you plan and prepare for this. I'm not going to tell you what to do. I'm not going to come out and tell you, oh, do this, do this, do this. I'm going to tell you what I see. I'm going to tell you what's coming. I'm going to make recommendations, just like I've shown you. And then you decide how you want to handle your money, and you rely on my research to make smart decisions. That's what it's all about. Okay, guys, so be prepared. We're looking at a very strong downward price decline. I don't know how to say it any other way. Oh, I moved this the other direction. We are looking at this line, this red line right here. We are going to see the SPY consolidate back down into this area, 395 to 405. That's going to be my target for the next 3 or 4 months. Then we're going to start a nice little rally here through the end of the year, I believe, trying to retest these highs, maybe get a little higher. So be aware, it's literally not about the daily finding the next big hit. It's about protecting your capital, waiting for the right trade setup, knowing that you're going to be able to survive the market trends as they're setting up, and preparing for the moves 2 to 4 months in advance. Okay, hope you guys liked the video. Please visit MENT.com and check out what I do. I'm trying to help you, and I believe my research is well worth the monthly cost, about $45 a month. Thanks again. Talk to you later. Bye.